In this video, we're going to do something very exciting together. We are going to build from scratch a dividend portfolio using Freetrade. I'm going to put £1,000 of my hard-earned money, in fact money that I was paid in dividends from another account, into this new portfolio which we are going to dedicate 100% of to dividend-paying companies. In order to do that, we're going to pull together a well-diversified portfolio of companies, and all of these companies are going to sit on the FTSE 100, so they're all going to be ones that we can buy very, very easily from the UK, and none that we're going to have to pay any dividend withholding tax on. And even though they'll be listed in the UK, it doesn't mean that they won't be getting most of their income from outside of the UK. As you may already know, around 70% of the income from FTSE 100 companies is generated outside of the UK. So we're talking in companies all the way across Europe, North America, China, Asia, the rest of the world, etc. So by buying into some of these huge household names, we'll actually be giving ourselves a well-balanced, globalized portfolio. Once we put this list together, the idea is that we keep reinvesting our dividends year after year, month to month, depending on when we receive them. And then we should benefit from the double whammy of capital growth, as the share price should hopefully increase over the years to come, and also from the juicy dividends that we've been paid, and gradually we'll get that compounding snowball effect. If you'd like to see regular updates, or you're also doing something similar, please do let me know in the comment section below, and also drop me a big fat like. I've heard if you press the like button, you can actually get an extra 1% dividend yield on dividend stocks. Might be a lie, but you can press it nonetheless and try. And as always, I'm not a financial advisor and I never claim to be, so please do all of your own research before investing to any kind of stocks and shares. Make sure you look after yourself out there, but without further ado, let's get straight into this. So firstly, why do this? Why invest in companies that pay dividends? Don't dividend paying companies waste all of their money by paying it out to you and me? Aren't those big dividend paying companies slow and not going to grow anymore?
Only a very bad company would pay out all of their cash to dividends, surely.
Well, it's definitely an interesting conversation, and it's not all rosy. There definitely are some trade-offs when you're looking at dividend-paying companies. You can't just have those juicy dividends without having something on the downside. Remember that when we're talking about dividends, we're of course talking about that money which is given out to shareholders just for holding a stock. And this amount can be paid monthly, annually, biannually, whatever they choose, whatever the board decides, and the amount is completely at their discretion and absolutely nothing is guaranteed. Remember though, it's not all free money. When a company pays out their dividend on that payment dividend date, often you'll see the share price drop in exactly the same way as the share price payment which has just gone out the door. So for example, if you had £100 worth of stock and they paid out 5% dividend yield, you might get your £5, but then your stock's actually worth £95, so you've still got £100. Unfortunately, you can't just buy a share, get the dividend, sell out of it and hope to make a profit. You won't be the first person that's thought of that, and don't worry, I had the same thought as well many years ago. Historically, dividend companies have done a couple of different things which make them stand out from the rest of the crowd in the stock market. For example, firstly, when we look at dividend-paying companies, historically, when we look back at the market, especially over in the US, we can see that dividend-paying companies have actually slightly outperformed companies which don't pay a dividend and the overall general market. There's some great data that goes back to 1920 that looks at stocks all the way up to 2014, and actually the biggest gainers during that entire time were those who paid out dividends, and once you reinvested those dividends, you find that you'd actually beaten the market if you were to just buy a long-term index fund. And secondly, dividend-paying companies tend to be a lot less volatile than other companies who might be going for growth and reinvesting all of their profits. And this tends to be because those larger companies are the ones who are more comfortable paying out dividends, whereas the smaller ones who want to grow really, really fast reinvest all the cash coming back into their business. So it's a bit of a balancing act. So the benefit means that it's a lot less volatile. So if you are an investor who doesn't like seeing red days and you look at your portfolio every 10 minutes, so at least with dividend stocks, you'll tend to see a little bit less volatility, not necessarily any less risk though. If we think of some of the best examples across the world, one of the biggest household names that comes to mind is Coca-Cola, who have been paying a dividend for over 50 years. And I don't think that anyone would be saying that they're a bad company at all, but of course, once you get that big, there's very little more you can do in terms of trying to go for growth. Right, so now it's time to talk about the companies that we've chosen. And of course here, we don't want to have any companies which are going to be too small. We want sustainable, long-term dividends and companies that have been around for a long time, and especially ones that need big enough that they're not going to go bust anytime soon. And also remember, the companies that I've chosen on this list, I've not necessarily gone and talked about the ones which have the biggest dividend yield, because of course, that doesn't necessarily mean they're the best. the largest dividend yield is not necessarily the most quality, because of course it's all about that sustainability over the long term. There are at the moment, if you have a look on the FTSE 100 dividend yield, there are plenty of companies out there who are delivering even 10% plus dividend yields currently, but in the long term, it's not necessarily very sustainable. I would rather keep to companies that are much better quality and can deliver me that dividend consistently rather than being all over the place. Otherwise, we may as well just go invest in something else. So where do we start? Well, firstly, we need to look at the FTSE 100, how it's broken down. And of course, I want to try and get as much exposure to as many markets as possible around the world and all the different sectors that make it up. So as you may already know, the FTSE 100 is made up from 11 different sectors. The largest sectors are things like consumer staples, so things that you need day to day and things that you need to buy, like food and drinks and all those kind of things, to financial services. So that's all the banks, which whether you love them or hate them, you still need to also use. And then of course, things like healthcare and materials too. So big industrial companies who make things which are essential to be able to make and produce things around the world. Now, I'm not going to go into massive detail on the individual companies, otherwise we'll be here forever. And to be honest, I don't want to spend half of my life going through the balance sheet and income statements of different various companies. I'm just going to be basing my decision so far on having a well-diversified portfolio and giving ourselves a nice foundation to build on. Of course, in the months and years ahead, we can always tweak this if we need to, but for now, this is just somewhere we can start, a nice little foundation for us to build on. Right, so I've just put this up on the screen now for you so you can see all the companies that I'm going to be investing in today. So I think I've got most of the markets covered and I've got most of the leaders in their spaces. And I'll run through them now. We're going to be going for Unilever, BP, Diageo, National Grid, Legal & General, Aviva, GlaxoSmithKline, Tesco, Vodafone and HSBC. And I've just done a quick tally as well to say that the average yield of the ones I've selected is around 4.7% currently with the dividend yield. And the market overall, the FTSE 100, is around 3.4. So we are going to beat the outcome of the market in terms of the dividend producing, but hopefully we can also beat it in terms of growth. Fingers crossed. And now the exciting bit, I'm going to jump onto Freetrade on my phone and let's actually go and buy some shares, and I'm going to try and equally weight them to get around £100 worth of each share. Before we do that, if you do want to get started with Freetrade and join me, you can use one of my links in the description below. If you sign up and deposit some cash, we will both get a free share all the way up to £200 each. What's not to like? Some free money. And hey, maybe if I get that free stock, I'll sell it and then I'll buy another dividend stock and grow it together. Right, so we'll bring up my Freetrade app now. As you can see, I recently put in £1,000 of my hard-earned dividend income. So I've now popped that in the account. You do want to know how to do that. You just go to the account section, and then once you've linked a bank account, you will click that and you will top up your account through your bank account. So for not having used Freetrade for very, very long, I can see that it's very, very simple and very, very easy to use. Now you don't get bombarded with all the information, all the different stats on things, but either way, it's very easy to go and buy a company. I'll just show you how to do this now. Certainly if you've never bought a stock before, you'll be amazed how quick it is. And of course you can be a shareholder in just a couple of minutes. Now, we are doing this live during market hours, so you can of course buy a stock and it'll be yours straight away. If you were buying this out of hours, of course you'd have to wait a bit longer. Anyway, let's go from the top. So we'll start with Unilever. So of course you can just search, if you did know the ticker symbol, so this would be ULVR. I love how the category of Unilever says soap. I think they do a lot more than that. So that's Unilever, so that's great. We can go into long-term statistics and graphs and fundamentals maybe in another video. But for now, of course, ultimately this is a staple of the portfolio and of course delivers a really nice dividend yield. So I will hit buy here. And I want to try and get, of course, as many shares as possible, but that's going to give me only 2 shares, isn't it? So I really need to pop in that to give me there. Get 3 shares of Unilever. Buy. Of course, the actual trading of Freetrade is free. The only fees you're really going to be looking at here is stamp duty, which you have to pay on every single UK share. Unfortunately, it's 0.5%. Need to keep the Queen in business there. And look how quickly that's gone through, so that's fantastic. So we now own a bit of Unilever, and let's go through. So if anyone tells you that investing is complicated and you need help to do it, you can just show them this video. So next, let's go to BP. Again, let's put £100 in here. BP's share price is a lot smaller, so I should be able to fit into the £100 mark a lot easier. Let's review this order. £98, confirm and buy. Just wait for that one to send. So BP, obviously huge oil and gas producer, one of the leaders in the space. I was going to put both BP and Shell in this one, just to give myself even more exposure, because of course sometimes it's difficult to pick winners. But BP's done fantastically well, and ultimately will be part of that green revolution regardless. Fantastic. On to the next one. So this one's not going to be the biggest dividend payer, but Diageo, one of the largest manufacturers and distributors of alcohol in the world. So of course, who doesn't like to have a drink to celebrate? They own many hundreds of different kinds of brands, including people like Johnny Walker, etc. And they even own Guinness as well. So again, this one, they are 35.85, so I probably need to do a little bit more to get my 3 shares. Otherwise it'll be a bit boring. £108, buy that one. Always exciting buying shares, never gets boring. Okay, next one down the list, National Grid. Everyone in the UK will be familiar with National Grid, and of course they are a nice stalwart when it comes to paying their dividends. Of course, regardless of economic conditions, there will be a good place to invest because we're going to get our dividend regardless of market conditions. Okay, excellent. That one's done. On to our next one. So we've chosen legal and general. You'll see I've chosen legal and general, and I've also chosen Aviva. I may as well have some of both the leaders in the kind of financial and investment and life insurance space. Why not? We can always see who beats each other. Okay, so buying some legal and general. Very gamified, isn't it? Buying stocks and shares. Right, Aviva. I might even speed some of this up. I just probably put some interesting music because although it's fun, it's not the most interesting thing to watch, is it? So we're putting up £100 here. Review order, £99.50. Boom. Thank you very nicely. 4 more shares to go. 4 more shares to go. GlaxoSmithKline. Of course, it's a very easy search function, isn't it? Because you get the logo as well, which is very handy. What have we got left? Confirm. Then just 3 left. We've got Tesco, Vodafone and HSBC. Of course, 3 very different sectors to give ourselves a nice diversification. We don't really want to be relying on one person for income, especially if this was dedicated for income. And that's an important thing I haven't really touched on. Let's say if you were doing this purely for income and you wanted a reliable income, you definitely wanted to have a very diversified portfolio because you can't be reducing your income if the economic conditions are poor. We don't want that. So there's Tesco. So when I next go shopping with Tesco, I'll make sure they know I'm a shareholder, see if I get any perks. There are actually perks for some companies. Might have to look into that. Probably not Tesco though. Don't you get free popcorn or something like that if you're an AMC shareholder in the States? You can get discounts. There's some good websites to go to see what the crack is. Vodafone, let's go. Vodafone share price, if you look at the graph, is pretty horrific to be honest. But the yield's quite high at the moment and they are a big old company. Then their net income is a bit rubbish at the moment. They've got huge revenues and they've got a big balance sheet in terms of assets. So they're not going anywhere. But they do need to work out some more interesting ways of making a profit. And then finally, I guess we'll use as much as we can on HSBC. Should we just clean up 1, 3, 5, 6, 7. We'll just put as much as we can. 31 shares. Confirm buy. And that will be us. Okay, great. So that's us complete. Now if I go to portfolio here, of course the share prices will keep updating. And we've got a nice little portfolio here of dividend growth. Looks quite nice, don't you think? Right, so that's all done. So if you want to keep track of dividend payments, of course, you probably want to mark them in your calendar or have some other method of doing that. All your dividend payments, if you're brand new to this kind of thing, will just go into your account. And of course, they'll sit there as cash and be up to you to then reinvest. Now, my plan, of course, with this portfolio is to get that cash and I'll reinvest it. Depending on how much I get paid, I might not be able to buy a full amount of shares, so I might have to save it for a few months. But any money I get, I'll add to this portfolio. We'll keep track of it and see if it can maybe beat the market. But for now, this is what I've put together. Let me know in the comment section below if you'd make any changes, if you think I've made any absolutely awful choices here. I haven't gone into too much depth because I don't want to get obsessed about fundamentals of a company. I think, remember, we are thinking long-term here. We are thinking long-term growth, but still, if I've made any stinkers, let me know. And just remember that investing and dividend investing, it's long term. You're not going to make much money from that. Even at £1,000, 4.7% is only £47 in a whole year. So this is not the kind of thing that's going to make you rich. You really need to do a couple of things from here. Firstly, is go for the long term. And secondly, make as much contributions as you can, make as much as you can into that portfolio, whether that's every month or various lump sums, because that's really the only way you're going to get rich with investing. You're certainly not going to be able to buy much with £47 unless you don't reinvest it again and again and again. Anyway, I'm looking forward to seeing that grow. Please let me know in the comment section below, or drop me a big fat like if you've enjoyed the video. Subscribe if you're not already for many, many more videos of similar subjects. Of course, I love talking about investing and personal finance and dividend investing as well. But with that being said, thanks so much. And as usual, happy investing.